Well, of course, we know this was a year with any number of challenges. You can pick them. We know we've seen quite a run in the equity markets, and it's been a bit of a risk-on trade. But what does it mean for our personal finances, particularly if you're in a part in your life where you're not supposed to be sticking yourself out and putting that neck into the risk trade? You're supposed to be getting a little more cautious near retirement or in retirement. Let's bring in Som Seif. He's the founder, CEO of Purpose Financial, the future of spending, the future of personal finance. Som, these are tough times if you're looking for returns in anything that could be considered safe.
Yeah, no, it's not a tough time, Greg. And by the way, happy holidays to you and all the listeners and viewers. It's not a tough time if you're actually looking at the stock market, is it? But it is absolutely a tough time if you're thinking forward. We think a lot about, positions of portfolios, not from a historical return perspective, because, what has been done has already kind of been banked in many cases, and whether you've been participating in some of the markets or not, but really about how can you plan forward, and especially as you get into sort of later in your career where you go, what I always say is this period of your portfolio becoming your, pile. You've saved for many years, and now this pile is going to basically build your income needs for your long-term life. This is a time when you have to be very thoughtful and very structured, and it's very hard today to look forward and be very thoughtful given the lens that we have in low interest rates and kind of the high valuations in stocks and such. But it is an interesting time, and it's a very important time for investors of all stages, but specifically later in their portfolio thinking right now.
Yeah, obviously, I mean, we have entered into, not even entered into, we have extended the era of cheap money after the financial crisis, the central banks slashing their rates, trying to support the economy through that. We never got back to what the central banks kept telling us would be some sort of normal policy rate before all of this hit us. And again, the savers are punished, but other asset classes start to soar. I even think about Bitcoin and what we've seen there this year. I mean, there is money being made out there, but it is not safe and secure money, considering how volatile these trades can be.
Yeah, I mean, if you wanted to make, a 6-7% return, 20, 30 years ago, you could effectively do that by predominantly owning bonds. Today, you could find that nowhere in the bond market, of course, unless you were taking very, very large risks. And of course, you'd have to start to gravitate towards larger, more risky areas like the equity markets, like specific things in the gold and cryptocurrency areas, which have been performing relatively strong this year. But I think that, again, for an investor, I think that's not really the right decision. An investor that is thinking about kind of monetizing their long-term needs for the next 20, 30 years of retirement, they need to really be focused on risk management. And, I think that it is a time to step back and make sure that one, you've got enough savings. That's the first and foremost thing, is have you built a big enough pile in the context of the required return? Have you got a realistic assessment of what the return that you need is, and if you think you're going to make 6-7% with low risk, then I think we need to think again. And so it's more like, do we have enough money relative to making 3-4%, in retirement? And then it's a question of, okay, how does that portfolio get constructed? And frankly, I'm not a big believer that many people in retirement should be holding a lot of things like cryptocurrency or very risky tech stocks and such like that. They can be a component of a portfolio, but they shouldn't be a meaningful component of a portfolio.
When I think of the household balance sheet and what we would find in terms of assets that have shown strength, particularly for people who bought a home several decades ago, if we're talking about retirement or near retirement, obviously your home, the value of the home has gone up dramatically, but this is the roof over your head. I just think when you look at the balance sheet and say, well, how have my stocks been doing? How has this been doing? My bonds? Of course, my house has skyrocketed, but I need my house. I mean, it's not exactly a liquid asset.
Yeah, well, and I think this is where we have to start to be more thoughtful about kind of planning. And so, there are really interesting opportunities to utilize your house and the equity that people have built in their houses to find and fund their long-term needs from an income stream perspective. I don't think that the tools that have been put into the marketplace today with some of the chip mortgages and the reverse mortgage products are set up for that type of customer in an appropriate way. They're not customer friendly, in my opinion. I think they can be done so much better. But I think that we need to kind of, as an industry, restructure and rethink the way that we support retirees in their income needs from all of their balance sheets. So not just what have they saved in call it liquid, their RSPs and TFSAs and savings and defined contribution plans, but also, what have they saved in terms of putting away and paying down their mortgages, paying down and making sure that they've built up equity in other parts of their, whether they have apartments or other types of things. These are very valuable assets to a retiree. And I always say you need a house, you need a roof over your head. You don't need to own the house necessarily, but many people really value the fact that they pay down their mortgage and they want to live in that house for long term. But there's lots of equity in that house that needs to be rethought. And I think that the whole industry, our whole industry, has to do a better job of supporting people and supporting their income needs later in life in that way. So I think there's a lot to be done around this. I think at a time like this, you need a catalyst. And maybe this is the catalyst that really forces us to rethink retirement planning. 1% interest rates just aren't going to do it for people, who need to make sure that they have a real secure income post 65.
Yeah, no easy answers, but at least we're having the discussion. We'll continue to have it in 2021. Som, have a great new year when it comes, and we'll talk to you soon.
Great to be here, Greg. Happy holidays and happy new year to everyone.
Som Seif is the founder and CEO at Purpose Financial.